Okay. So from all my readings and that as well, we know that the 18-year cycle is an average. So you could give or take 1 or 2 years. Do you think it's possible that 2024 could be the top of that explosive phase?
Actually, as you're answering that, can we move to the next slide? I think it's a really good visual that
Yep.
you've put together that describes the different phases, and that'll help listeners understand where are we in the cycle and what it looks like. Thank you.
The peaks are actually a little bit easier to forecast than you sort of expect when you look at the data. So in the US, you normally get the peak coming a little bit earlier than you do in Australia. And so the peak in the real estate market, I would be expecting to be around 2025. But you're absolutely right. It's an average cycle. And real estate, the way that we're analyzing where the peak is that we're looking at median values. So we're looking at the middle number of a bunch of sales. And that's clouding. I mean, in Australia, if you were to say to me, well, where is the peak going to come in Australia? We can either look at the median price of Australia as a whole, or we can look at the median price of Melbourne, the median price of
Sydney, Adelaide.
and they're each different. I mean, the WA works on the commodity cycle, so it's a
Yep.
commodity, so it booms and busts based on commodities. And in the 1890s, when it tends to go contrary to the cycle almost, in the 1890s when the East Coast was having a huge major downturn. The WA was booming. Their real estate was booming because, we were losing, we'd had the big gold bust and they were finding gold. So it really does apply slightly differently elsewhere. So when we're talking about it, we are talking about on average. And and this was really where Roy Wenslick did amazing work, because he said, look, I've never said it was exactly 18 years. It's on average 18 years. So you can get a peak coming early in the cycle, or you can get a peak coming late in the cycle. And I would argue that to some extent now, when it comes to real estate, that's really because of government intervention. We have a lot of, tinkering around with tax policies. Just look at what's happening now in Victoria. We have Dan Andrews that is raising land tax and talking about freezing rents. He hasn't, but he's certainly put a cap on short-term rents for Airbnbs. Now, all of that has an impact on the value of real estate, because that's the earnings of real estate. That's why when building prices go up, that has an impact on the value of a vacant block of land. But it also has an impact on the value of an established house on a block of land, because it becomes cheaper to buy an established home than it does to build a new home. And because when that dynamic changes, then that's where the real estate, you'll do better if you own vacant blocks of land than you will if you own, land with established housing on. So it's a cycle that plays out slightly differently. So it's important to understand that it is an average cycle, that it does have variations to it, and you need to read it in line with what's happening in the economy. And it's also, I think, important to really understand how it applies to the stock market and the timing on the stock market. And the timing on the stock market really is best analysed by looking at some of the old cyclical, experts. I'm talking about people like W.D. Gann and Samuel Benner and George Tritch, who wrote these kind of economic timetables, or these economic timetables that were out at the time. The authorship of some of them is a little bit of a mystery, but they were kind of using an 18-year cycle to also show you where the best time to get in to the stock market and when the best time to get out, whether it be the stock market or the commodity market. And they weren't doing it because they understood how impactful real estate was on the economy. They were doing it based on what they were looking at, stock market chart. And so it's a little bit easier, I think, timing it, understanding the timing of that gives you a little bit more knowledge as to why I would say to you that I really don't feel personally, and I'm not the only author writing about this, and I know other authors have different ideas, but personally, I would not be saying that we were looking at a cycle that was going to extend late into the 2020s. So we would still be looking at, an upward surge in the stock market when we get into 2028, rather than going into some kind of really bad recession, depression. And I'm doing that based on astro stuff. Now, the thing that we all have to do is remain humble. So if I'm wrong, it's something for me to learn in the future, but that's based on learning. And it's always easy to look back in hindsight and see these things. But, that's just an understanding of how cycles work.
Yeah, exactly right. And you're right. Like there could be, I don't know if you know much about the 90-year depression cycle as well. So 90 years ago was the 1930 depression. 90 years before that was the 1840 depression. 90 years before that was agriculture depression. 90 years before that was your financial revolution and tulip mania. So it's like around that, I guess, 90
Yeah,
years is when you have this kind of depression cycle.
yeah.
When's the next one?
They all align with this cycle, though. That's the significant part. So I agree. Like they're significant depressionary points to look at. But if you use them in line with the real estate cycle, I think it gives you almost an extra bit of timing. So you're absolutely right. And of course, those anniversaries are something that we have to take into account. Sorry,
ASX. When's the next depression one cycle?
Well, 1930 was the last one. 90 years from that is 2020, which is why a lot of people were scared when the 2020 COVID crash happened. But then obviously the government stepped in and have stimulated further, which has delayed that. So whether or not they have just delayed what was going to happen or what is, I guess, the question. And I guess it's that 90 years because that's the kind of like anyone living through the last Great Depression is not really living right now. So humans make the same mistakes over and over again. But looking at this cycle here, the expansion, and then I guess the thing that I'm going off is I feel like we'll be going into a recession next year. So if we're going off this, does that mean that we're starting to then come into this recessionary area here, which then leads into the excess supply? Obviously, we've got, like you said, immigration coming in. Vacancy is still, there's still so much housing demand things out there like that, but that's more of I guess, a lagging indicator as well. We definitely have the rise in interest rates. We definitely have, I guess, the economic downturn coming, and there are people struggling not just in Australia but around the world. I've just spent the last 3 months in Canada, and last time I went to Canada, just before COVID, I remember going there and felt that everything was a lot cheaper than Australia, and just things seemed really good. But this time it was way more expensive. Everyone was hurting probably more than here in Australia, and that's when I started to realize that it's not like this. It could be a global thing that's happening. It's not just a recession to the country, but it could be happening around the whole world because of everything that happened from COVID. So that for me is what also aligns with that depressionary cycle as well. Is a bit scary that actually every single country is feeling the pinch as much, if not more, than how Australia is as well.
You see, I wouldn't say that we're going into a recession next year. I think that it's quite the reverse, that we're going into really, and again, this is kind of based on the cycle, but we're going into the final 2 years of the cycle. So you would expect, the thing that we're seeing, obviously, again, it's like understanding the role of real estate in the economy, and that, when you've got real estate values that are going up as they are at the moment, we had a lot of people that said, okay, interest rates are going up, that's going to cause a crash in real estate. It didn't. Those kind of fundamentals need to be looked at through the lens of a cycle, because if you don't, and I think you said when we spoke on the phone, you very accurately picked the point where the market would pull back and everything by applying the kind of cyclical knowledge. So what you would expect to see, is even though interest rates have carried on going up, real estate has as well. All states at the moment are recovering in real estate values. They're not booming, because in order to make real estate to boom, you really need a credit rush. But there's enough drivers that we have right now to encourage real estate values upwards. And part of that is immigration coming in, and immigration mostly coming into areas that are very short on supply. We've had numerous building companies that have gone into administration, which means that we just don't have a lot of supply that's coming on board. And that supply that the government is trying to encourage now, not by getting people to build, but they're saying we'll release land. Well, developers aren't going to buy that land and flood the market with supply. Developers are going to drip feed that supply onto the market in order to maintain high prices. That's how the development cycle works. So we're not going to have a flood of supply that's going to come onto the market, certainly not until around the peak of the real estate cycle, which is where you would speculate that real estate values would start to soften. The only thing that I would say is that, and then we've got people speculating that interest rates might actually fall. Now, that's not me. I'm not thinking that interest rates are going to be cut, but there are analysts out there that are talking about that. We've had the RBA obviously put things on pause. We've got inflation coming down. So, I mean, if that did happen, certainly that would give some confidence to the real estate market. But the thing that we really need in order to get any boom, which is what we would traditionally expect in the final 2 years of the real estate cycle, and what we have actually seen historically, if you go back, this is very common, particularly in Melbourne, you get a boom in the last 2 years of the cycle, is some kind of credit stimulus, whether that's a buyer's grant, whether that's the banks reducing the serviceability buffer on, and putting an ease on lending, whatever it is, we would certainly need a lot more credit going into the real estate market to really kind of give it that boom. So it's a bit illusionary as to what might happen, but I wouldn't be saying that we would be going into recession, personally.
Interesting.
Might be wrong.
The only reason I'm thinking of that is just looking at the bond yields, and what I'm seeing on the charts here as well. And obviously, we all know about the yield inversion, stuff like that, and we're down at those levels. It's often nicknamed the recession indicator, and we're down here. And from what I can see here is that we're actually looking to. Let me just move this up. So we've come down, and often the biggest crashes happen once the yield uninverts. And what I can see here is that we've come down in this falling wedge pattern on bullish divergence, and we've moved into a sideways movement here. If we can get above this zone here, then we move into an uptrend. And whenever this moves into an uptrend, that means we're going to uninvert the yield curve, which is historically when we've had those massive crashes in the market. So you can see things like here, once this uninverted, this was the February, which is when the COVID crash happened. And if you go back to the GIFs, let me move out to the monthly. Things like here as well. Once it then uninverted, that's September 2007, we had the GFC. Here, this is the tech bubble, things like that. So it just seems like the big crashes happen after the yield curve uninverts, and then we come up there. And that's just what I'm a bit worried about there, is if this starts to uninvert and pop back up again, then you're right. That could be, normally things have broken that bad that the government needs to step in and stimulate in some way, which also then could send that up. What are your thoughts on that, Tung?
I think Catherine mentioned that the stock market pops before the property market, so the timing might be consistent, because after the yield curve starts to invert, you don't get a meaningful recession for about 6 to 18 months afterwards. So there is a bit of a lag effect. I've got a controversial view, and I think that the stimulus that you mentioned, the ASX, a second ago, it did mask a lot of the symptoms, and what that's done is it's really inflated the economy. So CPI right now is running at about 6%, but GDP growth is 3.4%. So technically the economy is growing, but it's measured in nominal dollars, and those dollars are worth 6% less than what they were the previous year. So my hypothesis is, in real terms, we're already in a recession. They just can't call it one, because in dollar terms, it's still growing. But in every other term, in real terms, inflation adjusted, we're actually going backwards.
Yeah, gotcha.
Yeah, I think definitely that's a valid point, is how we define a recession, how people are feeling within the economy. But I think just what you said there about, the stock market going before the real estate market. Yeah, in Australia, so 1987, we had the stock market crash, and then, real estate didn't peak until 1989.
Yeah.
And it's different in the US. In the US, you don't always see that. It's different. You see real estate values kind of peak before the stock market, but the actual crash, it doesn't happen until you kind of see that trigger point comes. But yeah, I mean, definitely, I think you've got something valid there. But again, I think that it kind of needs to be nuanced with the timing. it doesn't mean that it doesn't mean that the seeds of that recession aren't being sown right now. Like everything is being sown for that recession. And a lot of it is just, debt-based speculation into real estate, and the economy kind of suffers at the edges and you don't see it, just like even increase in homelessness because people can't afford the rent or whatever else it is, or slight increase in unemployment. All of those things are kind of like the erosion really of the real economy, and that's why we have the crash at the end. I mean, ultimately the bubble's got to pop. It's just a case of how we're going to time that.
Yeah, exactly. And yeah, when I was in Canada, when I was there 4 years ago, hardly saw any homeless people at all. And this time, I was actually like, I was scared to park the car on the side of the road because people would come knocking on my door, one begging for money, and they were everywhere. I couldn't believe how much it had grown. And asking all my wife's family and that they just said, yeah, it's gone exponential. It's crazy how much homeless people are walking around now. Let's go back to this slide here. So looking at that, and yeah, so for those that don't understand the cycle, that it's kind of split up into these four phases here, and Catherine's done a phenomenal job explaining the 18-year cycle there. And just to kind of dive a little bit deeper there as well, as that first recovery phase is where economic conditions start to improve, interest rates are low, consumer confidence is on the rise, and as a result, demand of real estate starts to increase. And this was obviously after the GFC, and we've had low interest rates since then, and property absolutely thrived during that time. So that was the perfect time to buy your real estate then. Then you've moved into this is what's called the seller's market. And I guess the key things here is demand often exceeds supply. We don't have that now. Okay. Demand is not exceeding supply. We have an undersupply of property right now. So we definitely don't have that. Property values reach their peak, speculation becomes rampant, and investors rush to buy properties in the hopes of future price appreciation. Similar to what Catherine said, that was, end of 2022. I had real estate agents knocking on my door every week, pretty much begging to sell. And my property myself had doubled in 3-4 years. So I built my house in 2017, and it had doubled in value in that 4 years time. Like crazy, phenomenal gains that people only kind of dream of, and that just shows you, during that kind of time. And then what's come next is the balance during the, when the first recession starts to slow down. Property prices may stop rising or even decline. This phase can be triggered from rising interest rates, which is what we've had. Oversupply of properties, we do not have that. Or economic downturns, which again we're having, but they're kind of being masked, as Tong was talking about as well. But demand decreases, affordability becomes an issue, which we definitely have that. Affordability is definitely becoming an issue right now. Properties, which we're going to talk about later, how that the household income, debt to income ratio, things like that. And then developers may scale back construction projects as well, and that's actually happening right now as well. And as Catherine talked about, a lot of the some developers have actually gone under because they, I guess, locked in prices before inflation hit, and then all of those materials were more expensive than they couldn't afford to build a lot of the things that they had already signed contracts for. Then after that comes the excess supply. So this is where properties decrease significantly. This is where you want to buy. Ample supply and low demand. Investors, buyers who have been cautious start looking for opportunities to enter the market at low prices. And this is the thing with real estate, is it's not like the stock market. You can't just log on your computer and sell whatever positions you want that day. The real estate market, it's kind of like when you're a fund manager, and they have to kind of distribute their stocks through time. I always talk about the only way that big money can sell is either through euphoria, where there's a lot of volume, so that they've got a lot of people buying, they can sell it, or through distribution through time. And real estate is similar to that. You either got to have that frothy market where everyone's just throwing money at houses and there's a lot of demand there to sell, or that you have to time it a bit before and get out before, because if you try and sell during this time, it's going to be a lot more difficult. Did anyone want to add anything extra to those kind of four phases that might help the listeners?
I can certainly just make a little bit of a comment about when to buy into the real estate market. And again, it's kind of very Australian specific. In terms of that, well, first of all, it's about, if you're buying it in a downturn, right, you certainly want to be assured that you're going to get some kind of growth in the first half of the cycle. So remember, the cycle is split into two segments. You've got a first half, you've got a mid-cycle slowdown, you've got a second half. In the first half of the cycle, it's a Melbourne and Sydney game. It's not a regional city game. It's not a small state by population game or territory by population. It's a Melbourne and Sydney game. They're the ones that will grow in the first phase of the real estate cycle. The other states and territories, not necessarily. It doesn't mean that you can't buy in a great area of Brisbane and not get some gain. It's just that if you're speculating, you need to remember that as the first rule. And then the second rule is you really only need to step into the real estate market when you get a sense that the market is about to turn, and there's certain leading indicators that will give you that. Otherwise, you can sit in a stagnated market for a few years. I mean, in the 1990s downturn, the market obviously peaked in the real estate market, peaked in 1989. And then by 1995, it had bottomed. Now, if you bought in 1990 as it was going down, you probably would have had real estate that was worth less in 1995. It didn't really start to turn until 1997. So you don't want to have your money stashed in something that is going to then go through years where it's not really gaining. And so real estate is really simple once you get a grasp of what you need to look for. The type of real estate you buy is as important as the location you buy it in. You need to remember that. Don't go and buy an apartment. Please don't buy an apartment. Let's just have that as one general rule. But
make more apartments, you can't make more land.
Absolutely. And so the thing that you need to remember, though, about stepping into the market is let's step in when the market's about to turn. You can tell that stock on the market starts to reduce. If you're watching the market every day, if you're looking at the leading indicators, and there's some great research agencies that give data away free. SQM Research is one of them, has a brilliant data on terms of how much stock there is on the market. So when you start to see that reduce, if the government says we need more buyers, we'll give you a first home buyers grant. You can confidently step into the market. And real estate's like, it's like once the ship turns, you've got a little bit of a while before you get a pullback. So you've usually got around between 3 to 5 years if you're in Sydney or Melbourne, where you've got kind of like decent price growth before you get kind of like a 1.5 year pullback in the market. So step in when the market's turned, not necessarily when the market's going down, but otherwise, everything that you've said is absolutely excellent.
Yeah, you're exactly right. And if you think about even the stock market, same thing. Money will buy up the quality first. If you look at the GFC, Apple bottomed long before a lot of the other stocks. Microsoft bottomed, things like that. Because again, big money knows that they're not going to zero. Okay, so they're looking to get them cheap, and they will always bottom. Same thing with real estate. Obviously, Melbourne and Sydney are always going to be sought after areas for the next 50, 100,000 years because they're the capital cities. So people will want to buy them up first, which is why the money will flow into them first. Like talking about what Catherine's talking about there, like if you look at Microsoft, economy. If you look at Microsoft when it actually bottomed, like who wouldn't want to own Microsoft? Okay, you're probably thinking, I would have loved to have bought Microsoft at the bottom of the tech bubble. But if you bought Microsoft bottom of the tech bubble, it's there. Your money then did nothing for 14 years.
Yes, I remember that.
You know what I mean? So, okay, yeah,
Yes.
now 20 years later, yeah, it's a great buy, but would you rather buy here or would you rather buy once it's broken out of its sideways range and then here? So this is what Catherine's talking about. Once it starts to turn up, that's where you want to be in because then you get this stuff. All right, because if you bought there, money did nothing for 15 years. I don't want my money doing nothing for 15 years. I want to start going it when it starts to trend and move back up. So that's just, I guess, taking what she's talking about with real estate and applying it to equities as well.